In this video, we are going to talk about estate planning. So why estate planning? Well, an estate, let's first define that, consists of everything you own, including bank accounts, stocks, bonds, real estate, and personal property. Everything under your name. Estate planning is a definite plan for the administration and disposition of one's property during one's lifetime and at one's death. So, yes, you are planning on how to, most people administer their own estate while they're alive, but as you grow wealth, and if you become really wealthy, you may have people running and managing your assets. But then also, in other words, managing your estate, but then also it's what's going to happen at the time of death with all your property. So, essential part of retirement planning, it is an essential part of retirement planning, and it has two components. Build your estate through savings, investments, and insurance, and those you're building your assets. And then transfer your estates as you wish at death. If married, include spouse and children in the estate planning process. Now, including spouse and children in the estate planning process just means that they're being included in the planning. It doesn't mean that you will leave them anything. And it happens. I'll explain later some of the practices and why, but sometimes some people in their estate planning, including their children, means that they're including in the planning that they will not receive anything. If unmarried, make sure beneficiaries have information about your estate that they will need. Okay, so, and even if married, the point is you should have somebody, whether you're married or not. It could be your spouse, could be your brother, sister, a kid, anything. A kid as in a children, one of your children, adult hopefully by now, that knows everything you have and where. Now, we're not saying they got to have the passwords and be able to log in your accounts. They just need to know you have an account with bank XYZ, with brokerage firm XYZ, that you own 1, 2, 3 houses. Which houses do you own? So it's not that they have access to your assets. They just know what are your assets. So in case of your death, and especially if it's an unpredicted death, like a sudden accident or something, they have to be able to know who to contact and who to call in order to claim those assets. A common thing that happens a lot with banks, they have a lot of checking accounts, for example, that are unclaimed, and they just have to sit there for years before the bank can say, look, nobody's claiming this, we are seizing the asset. And it's because somebody didn't know there was a bank account there for them to claim. So your retirement accounts, everything that you will own or entitled to, like a pension or something like that, you definitely want somebody to know about all those assets and any key information that you know. If you have security lock boxes at a bank, etc. New lifestyles and non-traditional households mean unique challenges, which means plan early and get expert help. What they're talking about here is that a lot of people now live together but don't get married. They just call themselves domestic partners. That's just one example. And then there's just a lot of different lifestyles now that are accepted in our social norms, but the legal system may not have caught up to that yet. So while a spouse or a next of kin can make a claim, a domestic partner may have difficulties making a claim automatically. One example, let's say you live with somebody, but you're not married, and you die, and your intention was to leave your estate, or at least some of it or most of it, to that person, but because you did not have a legal document of XYZ nature or will, then your next of kin, a brother or sister, for example, will have more rights on the person you intended to leave the state to make decisions on how the state is going to be executed and split. So that's what we mean by plan early and get expert help. That's just code word for get a lawyer to write a will. The opportunity cost of rationalizing. Opportunity cost, that word will always be around finance and economics. Demands of daily living can keep people from thinking about death. Well, yes, we know we will die eventually, but we don't like to think about it. And the busier that we are during the day, the easier it is to not think about it. Your beneficiary will have to meet with morticians, clergy, lawyers, insurance agents, clerks of federal government agencies, etc. Plan while you're in good health. 2 reasons. As your health deteriorates, you may not be able to do everything necessary just because of the nature of it. Or if you go suddenly into a severe health situation where then you just cannot do it. So it's not like, oh, I'm getting sick, I'm getting old, I'll do it. Things can happen suddenly. Another key element here about plan while you're in good health is because if somebody wanted to make a claim on your estate, and let's say you prepared your will when you were in bad health, it is possible that they can make a claim that you were not psychologically fit to do that estate planning at the time. And then the legal battles begin. So that's why you want to do it in good health. So there's no question that you were making bad decisions or at the time, or decisions you didn't want to make at the time. The aspects of estate planning: gather necessary documents, birth and marriage certificates, legal name changes, social security documents, all that list. And that's just a short list. Anything and everything about your life should be somewhere where it can be accessed by somebody in the case of your death. A will is the legal declaration of a person's mind as to the disposition of his or her property after death. Most people are familiar with the definition of will. Transfers property according to your wishes. State law determines distribution of your estate if you die intestate without a will. Intestate without a will. So, and that's what we were talking about earlier about domestic partnership, that if you do not leave a will, then there are state laws that decide who can then take over your estate, and then some fair distribution according to whatever the state law declares on next of kin, etc. Marriage and divorce affect your will. Review your will with an attorney. Marriage may revoke your will. May, and you can almost say will. It will revoke your will, because let's say you have a will in place to leave your estate to your siblings, and then you get married. By law, even because you made that will before you got married, chances are you did not say such and such person, my wife or husband, will not get this. So that then voids or revokes the previous will, and then state law applies again. So if you continue to intend to leave your estate to your siblings in this example and not to your spouse, you have to then add that to your will, saying, and update it with a current date of signature. My spouse will not get this, will be my siblings, if that's your intent. If not, once you're married, state law will kick in if you didn't update your will. If you got married after you wrote the will, that will supersede. Legal cost of a will vary. Sure. The more with people with a lot of estate planning to do and a lot of assets and businesses and complex stuff, the will be way more expensive than that. But your standard will, your average person will, those about right, those numbers. But of course, as time goes by, those prices go up. Probate is legal procedure proving a valid or invalid will. Probate is just a court. In other words, in court, they go ahead and take a look at it and review the situation, tell you the will is good or not. Types of will: simple will leaves everything to your spouse. Simple enough. A traditional marital share will leaves half of the adjusted gross estate to spouse and half to children or heirs. Now, while these two may seem like, well, what's the difference still? But also think if you have children from a previous marriage. So now it's getting a little trickier. So that's why sometimes you want to be very specific. Now, it doesn't have to be half. You can specify, but if you just do like the blanket statement, then it goes half that way. An exemption trust will passes everything to your spouse except for an amount equal to the exemption. So think of this, what I said here. It doesn't necessarily have to be half, but now you can specify amounts or percentages, and other people that or the people may get stuff. But here, a key difference is that there's going to be an exception, and it's going to be some kind of money that instead of giving it straight to the spouse or whoever you name on the will, it gets placed in a trust fund in order to provide income from the interest that trust fund generates. This is typically done when you fear that your spouse or the person you're going to give the money to may not be the best financial planner, and you want to make sure they get some kind of income over their lifetime. So you can give them a chunk of money, but also put another piece, whatever amount you want, in a trust, and then they just give him some kind of income throughout their life. And that's just the numbers. A stated dollar amount will, designated amount that passes to spouse. Percentages are better due to investment risk. Similar to what I said. But you want to do it in percentages, in those situations where money is going to come out from an investment account that was placed in. Because if the investments are not doing well in a certain year and you did a dollar amount, it's going to start eating away at the capital. Formats of will: holographic will, a will that you write that and sign entirely in your handwriting. This is true. This could be easily debated and challenged in court because it's just a handwritten will and signed. Formal will, that's your standard one. You go to an attorney, you pay a few $100s, and they have a witness sign, and everything is worded very properly in legal form to avoid any hiccups. A lot of mistakes can be made on things, the way things are worded here, and it can may become an unenforceable will just because of the wording. Now they're challenging the authenticity. Statutory will, type of form of will on a pre-printed form. This is just like the fast food version of wills. There's already pre-printed. You just fill out a few blanks and you send it out. Now, it has rigid provisions, may not meet current laws, and may be invalid if you change provisions. So because of being like a preset format, it has to be updated legally every time the law may change. And if the day you signed it, something has changed and that was not updated, then it becomes invalid. Or if then you change a provision, then it's not a will anymore. So writing your will, step 1 out of 3. Selecting an executor. This is the person that after you die will go ahead and make sure everything is done according to your wishes. And if you did not leave a will, they still may assign, the court may still assign an executor to then execute the transfer assets and the inheritances and everything according to whatever state law applies. Now, here's just some of the characteristics of the person they must meet in order to be an executor. Writing your will, major responsibilities of an executor. Prepare an inventory of the assets. This is why it's important. We said earlier, somebody must know everything you own in order for them to prepare this inventory property. Because if anything's missing on the inventory, it can't get found, whatever bank account or whatever other entity out there is just going to keep that property eventually. And these are the other responsibilities like taxes, liquidate and reinvest other assets if necessary, etc. Now, here it says liquidate and reinvest other assets if necessary to pay claims. Think of debts. That's the most common one. Similar to debts. Let me put, okay, so debts is up here, but there might be other claims out there that are the work similar to debt. In the sense of how it gets paid off. Writing your will, selecting a guardian. If you have children, and they mean underage children, you need a will to name their guardian and or trustee. If you do not have that, don't worry, they're not going to go to an affirmatory. The state laws will probably start going next of kin, family members, and go down the list. Now, if everybody says no, then yeah, they might end up in a foster home. Be advised that just because you name a guardian here, it doesn't mean that person has to accept. You're just saying who's the preferred person to do it. Now, typically that's a conversation had before you put a name there, but do understand there's no legal obligation of that person to take care of your kids. That's just you saying that's the person we start with. You may have a list of names as well. Such and such cannot. Sometimes they cannot due to the time it happens. Like you may have the conversation, they say yes, but then at the time of your death, the people, your first on your list said yes, but they have health issues now that they cannot do it. It could happen. Or they themselves died before you updated your will. So you can have a list to go down the list if you want to. Now, this is important because wherever your name, whatever assets that are for the children until they become adults, that trustee will manage the property for benefit of the children. But as you may know, that can be tricky to monitor. If you want to alter or rewrite your will, review your will if there are changes to be made. If you move to a different state, it's important. Will falls under state law. So a state may change laws and you don't want to fall short in case any nuance issues or something like that. But life changes, in other words. Life changes or you just change your mind. So we are familiar with prenuptial agreement between spouses prior to marriage. On both, one or both spouses often waive a right to receive property under the other's will or under state law. Consult an attorney. This can get real tricky. Prenuptial agreement versus will, or if you had a prenuptial agreement that they were not going to take assets, but then after you die and you did not have a will, the state law may still grant them those assets. So this is definitely something to talk to a lawyer about prenuptial agreement and your estate planning. Live-in will and advanced directives. Live-in will. Okay, advanced directives include a live-in will. Provides for your wishes if you become physically or mentally disabled. We touched on that earlier in this presentation. You may all of a sudden become ill to a point where there's physical or mentally that you cannot do a will, so what you want, or manage your assets anymore. So having a live-in will means this is what happens. You appoint a person and or how you want things to happen with your estate and your assets. This is not a substitute for traditional will. That's important. Always get with a lawyer. It's definitely worth the money to get a lawyer to plan all these things. You should have a living will and a regular will to follow up after your death. Now, These are the wills that we're going to talk about, like ethical will. These are not necessarily legally binding, but here's a way to write your intent of what you would like your legacy to be, I guess, in a way. New type of will that is a way to pass on your values and beliefs to your heirs. So it is not legally binding document, only the assets really. But people like to include it as a will, statements about your values and what you expect from your heirs to behave and as they receive your assets and what to do with them, if anything. Share lessons you've learned in life, express love and address any regrets, requires self-examination. Writer and recipients say the results are an invaluable legacy. Social media will. Now, this you definitely, this is new, definitely social media is a very new thing, but this is something you definitely want to have something in writing somewhere. Even if it's just say, go in there and shut down all my social media accounts. Because that way you have a legal document that if you have to contact the social media website or whatever it is, you have a legal document saying that now you represent that account and you need to take over it. Some people may want their social media to stay alive and have somebody manage it. Powers of attorney. You may have heard these before. At the end of the day, it's just you are giving somebody else the right and the power to do things for you, sign for you, etc. It says here, also known as a healthcare proxy, but it's not just for healthcare. It could be for many, many, many other things. Legal, that second bullet really is the key one. Legal document authorizing someone to act on your behalf. This can give, there are general power of attorneys, there are durable power of attorney, there are special power of attorney. The point is that you can either be very specific. This person only has the right to represent me on this, this, and that, and nothing else. That'll be like a special. Then you got the ones that you say is a blanket power of attorney, pretty much, where the person can do everything as if they were you. They can open accounts, close accounts, apply for credit, buy things, sell things. They can do everything for you. Letter of last instruction, after death wishes. Not legally enforceable in some states. Also, it depends what the wish is. Some states may say, yes, all wishes are, as long as it's not an illegal wish. This is a legally enforceable document. Some states may say, no, nothing in there is legally enforceable. Some states may say, like, well, some wishes are, some are not. Just be familiar with what applies in your state. So provides heirs with important information, such as the details of your funeral arrangements, names of people to be notified of your death, the locations of your bank accounts, safe deposit box, etc. To be honest, it's unlimited. You can write everything you want there. But the question is, what will be legally enforced or not? What can be legally enforced or not? Types of trusts and estates. Let's talk about trusts. Trust is a legal arrangement through which a trustee holds your assets for your benefit or that of your beneficiaries. You've heard the word trust fund out there before and all that. So all it is pretty much is the assets get placed in this trust, and this whatever entity, if you want to call it that way. But it's not really an entity, it's just that there it is. And then there's a set of instructions of how the assets can be used, disposed, etc. And let's say you're alive, you have your own assets, you yourself can put everything on a trust and then put the instructions there. And but then after that, in order for you to access those assets, you have to follow those same set of rules. Now, when people do that, it's not they're self-restricting, it's to provide legal protections. And that's a different course to talk about specific trusts and all that. But the point is that you can do that, or as we mentioned earlier, when you put money aside and just release a certain amount as income for the person receiving the benefits, same thing. Those assets belong to that person, but they cannot access it at will. It has to follow certain rules and instructions. Types of trust and estates. Trusts are either revocable or irrevocable. With a revocable trust, you retain the right to end the trust or change its terms during your lifetime. So back to what we said, you can go ahead and put the instructions, and if you do revocable, you can go back and update and change them if you want. Now, an irrevocable trust is you cannot change the terms or end the trust. Now, some people do that, and that's fine, because that way, then you cannot be pressured or you yourself, if you don't have the discipline, step away from the intended plan. But do understand, it is really legally binding. It's very difficult to deal with those if anything changes. Benefits of establishment of trust: reduce or provide payment of estate taxes. Avoid probate and transfer your assets immediately to your beneficiaries. Free you from managing assets. Provide income for a surviving spouse or other beneficiaries. That's kind of like tied up with the second bullet. Ensures property serves the desired purpose after your death. Types of trust. These are just some examples. There's all kinds of trusts. You can pretty much write a trust for anything, as long as you follow certain rules in the law. You got the credit shelter trust. You have disclaimer trusts. You have living trusts. And just like they sound, their names are pretty much credit shelter. That's an obvious name. Testamentary trust and life insurance trust. And these are just some examples. There are many more. And pretty much you just put a term or word in front of the word trust that describes what the trust is doing, generally speaking, or which what does it fall under? And then after that, it all comes down to what rules are written there. Estates. Make an inventory of your estate. Let's go over that again. So we did speak earlier of this important step when making an estate. Make an inventory of estate. Everything. This is just an example of a list, but everything, all the way down to if you should, of course, it's up to you to go however extreme, but all the way to the box of nails you have in the closet. Community property is any property that has been acquired by either spouse during the marriage, but not by gift, bequest, or inheritance. Half of the community assets included in each spouse's estate. So, just what it sounds like. Unless you have a prenuptial agreement or some kind of other contract in place, every asset is acquired, every wealth that is built during the marriage is 50-50. With some exceptions, this is just a few examples. It could be some other exceptions there as well, where it may not, the 50-50 may or may not apply. Joint ownership. Now, it is very common that if you buy a home, you both sign for the house. That's pretty much an example of what they're doing there. Now, what's important is that we have joint ownership. You can have this little tax break. Estate tax is paid when surviving spouse dies. Another thing is that, so estate tax is paid when surviving spouse dies, meaning that now gets transferred to your children. And now that estate tax applies. So now what some people do to try to avoid that is they create an example is an LLC, and then all the assets or the property owned is in the LLC. And then you have your spouse and your children in there. So if one person in the LLC dies, the assets is the same as a joint ownership of multiple multiple owners. Then the assets get sent down to the other members of the LLC, just like it would to your spouse with no estate tax. However, there are some limitations to that, but it's another approach to avoid estate tax down to your children. And then your children, when they receive it, they can continue that process, a cycle. Tenants in common, each individual is considered to own a proportionate share, and each can choose who gets a share at death. I guess in a way that's somewhat similar to the LLC example I gave. Different, but same idea. And tenancy by the entirety. When one spouse dies, the other gets the property automatically. However, notice how the no estate tax paid is not mentioned on these. Life insurance and employee benefits. Life insurance proceeds are free from probate and income tax. So whoever's the beneficiary of the life insurance, they get the money. There is no income tax or tax, etc. Assignment of ownership to your beneficiary can remove a life insurance policy from your estate. So understand that the life insurance, if let's say you have a will, but the beneficiary of life insurance list and life insurance supersedes anything else that is dealing with your estate. Unless payable to the estate that benefits from qualified pension, profit sharing, or other plans, like kill plans, are excluded from your estate. So if there is some laws that say who gets your pension, for example, if you die, who can continue receiving pension, to be your spouse. So unless otherwise specified that the beneficiary of the pension is the estate, then no, it will not be automatically part of your estate. It goes to the spouse. So that's why you need to write a will if you want something different to happen. Lifetime gifts and trusts. Gifts or trust with strings attached, such as retaining the income, use, or control of the property, are fully included in your estate at their date of death value. So yes, assets get valued at the time, market value, not book value. And then that's how it's decided what's going to happen to those assets. An example of why this valuation is important. Let's say you have 2 kids and your spouse already died. So when you die, the 2 kids are going to inherit your house that you already paid off, for example. And let's say they're going to get 50-50 and the house is worth $400,000. So they will not both live in the home. They may not wish to keep the home, or one way might keep the home, the other one not. So you put the value, they're entitled to $200,000 each. So there's a liquidation approach. Sell the house, get the $400,000, each get the $200,000 in cash. But then also what could happen is that, let's say one of the children wants to keep the home, then they're just going to find another way to transfer $200,000 worth of value to the sibling. It could be a cash payment from the sibling wants to keep the home, or it could be by them giving up some other assets they were entitled to. Because the idea is that not the individual items don't have to be split 50-50 to the 2 kids in the scenario. They just at the end of the day have to agree to what each going to receive. Sometimes there's sentimental value and they're willing to give up a little bit of their 50% or to retain a specific asset. So all those things can be negotiated between the person receiving them. Selling your estate. If you have had a will drawn, you are testate in the eyes of the law, and an executor named in your will will carry out your wishes in due time. We have spoken about this before. And in a previous slide, it talked about the typical responsibilities of the executor. If you don't have a will, you become an intestate. At your death, your estate is put under the control of a court-appointed administrator for distribution according to the laws of the state in which you reside. Then the court will decide on that executor, which earlier we mentioned the criteria qualification must have. Some assets pass outside of the will directly to your beneficiaries. So unless there's a very specific detail about something on the will, some default settings, to put it that way, by state law will apply. So federal and state estate taxes, pretty much this is a tax that the person receiving the asset has to pay. I guess a way to look at it is a form of income. You received a form of income and you have to pay for it. I like to use the example of, let's say in baseball, somebody breaks the home run record and somebody whoever caught that ball is going to be worth a lot of money. Whether the person sells that baseball or not, it doesn't matter. The IRS will tax that person according to that new asset they have worth so much money, whatever it is, the valuation is. So if you want to keep that baseball, you have to pay taxes on it because you are owner of a large asset now. You just received income. And that's so the same way. You receive some inheritance. There are some things, as we mentioned before, that do not get taxed, and there's ways to try to avoid some of this taxes when you transfer assets that way. However, expect some form of taxation. That's it for this video. See you on the next one.